Long-term yields back at levels last seen before the global financial crisis are colliding with an AI-driven capex boom and a fresh energy shock, forcing portfolios to work much harder today. This is vTalkInsight, Allocator's lens daily for August 19th, 2026, where we connect equities, rates, credit, currencies, and commodities into one cross-asset picture. Let's start with equities, where strong earnings and AI enthusiasm are being tested by rising yields and growing signs of fatigue at the long-duration end of the market. In equities, the core tension is between still strong risk appetite and mounting pressure from higher long-term yields. On one hand, the S&P 500 is reported to be less than 1% from record highs, and surveys show over half of fund managers overweight equities with cash balances around 3.5%. Near the most bullish readings since 2022. On the other hand, we are now seeing that confidence wobble at the margin. The S&P is heading for a third straight day of losses. The Nasdaq is down over 1%, and semiconductor stocks have dropped roughly 6%, pulling major United States indices lower together. Home builders are underperforming as mortgage rates climb with yields, and long-duration growth stocks, especially in tech, look increasingly vulnerable as discount rates rise. Supporting the bullish case, the earnings backdrop remains unusually strong. Profit growth outside of recession recoveries is running at levels not seen since the 1990s. S&P 500 margins are cited around 17%, and the AI capital expenditure cycle is still described as early, with hyperscalers committing trillions of dollars to infrastructure. Companies tied to data centers, cloud, and industrial build-out are seeing that in their numbers, while miners like BHP are reporting profit jumps of nearly 1/3, helped by copper strength. Yet this earnings power is far from evenly distributed. Market leadership is heavily concentrated in AI and megacap tech, and there are growing signs of strain. Recent commentary stresses that parabolic earnings surprises in corporate America are unlikely to be extrapolated, and specific names are carrying idiosyncratic risks, with one large social media platform facing a potential jury trial that could theoretically expose it to penalties comparable to its market value. Positioning amplifies that fragility. With equity overweights high, cash relatively low, and investor time horizon shortening, markets are more sensitive to short-lived narratives and spikes in volatility. VIX call buying into September suggests many are bracing for a choppier tape, and several commentators flag that a break in 10-year yields above roughly 4.75 to 5% could be the line where equity resilience finally gives way. That sets the stage for the rates story, because the equity outlook now hinges as much on the long end of the curve as on earnings. Turning to rates, the defining feature is a historic sell-off at the long end of the curve. United States 30-year Treasury yields are described at their highest level since 2007, around the mid-5% area, with yields in Germany, Japan, and the United Kingdom also at multi-decade highs. The curve has been steepening for several sessions, signaling persistent upward pressure on long-term borrowing costs globally. Crucially, the move is not being pinned on an inflation scare alone. Commentary consistently points to higher real rates and rising term premiums, as markets digest strong economic activity, intense demand for capital, and record sovereign and corporate issuance. Fiscal deficits are set to push United States government debt toward $40 trillion, while AI hyperscalers and other corporates are selling unprecedented volumes of long-dated bonds, intensifying competition for investor balance sheets. At the same time, underlying inflation forces are seen as stubborn. Higher oil and refined product prices, elevated diesel spreads, Russia's diesel export ban, and climate and fertilizer pressures on food all point to what some describe as a more inflationary macro regime. The Fed is viewed as worried about structural inflation staying above target, but markets are unconvinced it has a clear strategy to get back to 2%, and swaption markets show implied volatility steepening at the long end as investors demand more compensation for duration risk. The portfolio impact is profound. Stock-bond correlations are cited at their highest in 25 years, meaning bonds are no longer acting as reliable hedges when equities wobble, and the classic 60-40 mix is under strain. Several voices warn that a sustained break above 5% on the 10-year would be a critical warning signal, potentially triggering further repricing right across fixed income and equity markets. Even so, Flows show clients rotating from cash into short and intermediate maturity bonds and core bond exchange-traded funds, seeking to lock in 6 to 7% type yields while accepting that volatility on the long end may stay elevated. In credit, the message is that markets are wide open and extremely busy, but the bill is rising. United States investment-grade issuance is up roughly 20% year-on-year, with 4 consecutive record months and supply running well over 30% above last year in some estimates. Much of that is linked to AI and tech infrastructure, including large multi-billion deals from hyperscalers, and this wave of financing is helping to power the earnings and capex cycle we see in equities. Despite that supply, spreads have only widened marginally. Commentators note that most of the yield pickup in credit today comes from higher treasury rates rather than wider credit spreads, and investment-grade bonds from leading AI names can offer a premium over treasuries, backed by strong balance sheets and visible cash flows. Flows into investment-grade corporates and municipals remain robust, and private credit funds, while seeing redemptions, are managing those without forced selling, with new demand focused on higher quality tranches. Beneath the surface, however, risks are building. Record issuance is extending duration and increasing sector concentration in both bond and equity portfolios, skewed toward a relatively small group of AI and tech-heavy issuers. There is also growing complexity in corporate bond structures, including special-purpose vehicles and lease-back collateral that demand more rigorous analysis, and recent regulatory probes into opaque affiliated investments at one insurer have sharpened awareness of counterparty and transparency risk. From an allocator lens, the key question is when higher yields stop being a tailwind and become a headwind for credit. For now, easy financial conditions and strong growth keep default concerns contained, but commentary flags that the same record issuance supporting profits today is also crowding out the bond market and pushing risk-free yields higher. That sets up larger refinancing and spread widening risks if growth slows or if the rate shock deepens, and it means credit cannot be viewed in isolation from the dollar and global policy divergence in currencies. In foreign exchange, the backdrop is a firm dollar and a very strained yen, both tightly linked to the rate story. The dollar index is expected to stay strong in the near term, with targets around the low 100s, supported by higher United States yields and relative growth outperformance. The Japanese yen is hovering near 160 against the dollar, and some analysts think authorities could tolerate even further weakness toward the mid-100s if United States rates keep rising and the Bank of Japan lags. Japan faces a policy dilemma, with weak domestic growth complicating the case for rate hikes even as a soft currency imports inflation and tests the credibility of its framework. Cross-border hedging flows add another layer. For the first time in decades, hedged yields on Japanese government bonds now exceed those on United States treasuries, which could reduce foreign demand for American duration of the margin. That in turn reinforces the upward pressure on long-end United States yields and feeds back into the broader cross-asset picture, particularly when combined with high oil prices that must be paid in dollars. Commodities round out the story, with energy and industrial metals both playing central roles. In oil, escalating tensions in the Strait of Hormuz and the Bab el-Mandeb, vessel attacks, and a breakdown in United States-Iran diplomacy have sharply curtailed flows through key shipping lanes. Brent is holding above $90 a barrel and West Texas Intermediate around $85, while Americans face record seasonal gasoline prices despite softer recent inflation prints. The pressure is even more acute in refined products. Global diesel markets are described as under severe strain, with refining margins near $70 per barrel and diesel prices trading far above normal spreads to crude. Russia's ban on diesel exports through year-end is tightening supply further, and the combination of higher fuel and fertilizer costs is feeding concerns about persistent inflation and stagflation risks. On the metals side, the narrative is more constructive for growth, but still inflationary. BHP has reported a near one-third jump in profits, largely thanks to strong copper prices, and plans to increase copper production by about 50% over the next 5 years through organic projects in Chile, Argentina, and Australia rather than expensive acquisitions. Demand is increasingly driven by renewable energy infrastructure, grid upgrades, and AI-related data center build-outs, reducing dependence on China and supporting the idea of a global industrial and energy transition supercycle. For portfolios, that leaves commodities and other real assets as a double-edged sword. They are clear beneficiaries of the current regime and offer potential hedges when AI-linked equities or geopolitics sell off. But the same forces that support copper and oil also harden the floor under inflation and keep upward pressure on yields. That feedback loop is central to today's cross-asset environment and brings us to the broader wrap-up. Bringing it all together, we have equity markets still leaning risk on, powered by unusually strong earnings and an enormous AI and infrastructure capex cycle, yet increasingly sensitive to every move in long-term yields and to pockets of concentration and legal risk in megacap tech. Rates markets are signaling a regime change, with multi-decade highs in global long-end yields driven by real rates, term premiums, fiscal dominance, and energy-related inflation rather than a simple short-term data surprise. Credit is funding the boom with record issuance and only modest spread moves. But that same supply is stretching duration, adding structural complexity, and raising future refinancing risk, especially if the 10-year pushes decisively through the 5% area. In currencies, a strong dollar and an exceptionally weak yen underline policy divergence and may be quietly reshaping foreign demand for United States duration. While in commodities, an energy squeeze and robust copper demand tie inflation, geopolitics, and the AI story tightly together. For allocators, the key watch points are clear. The level and speed of further moves in 10 and 30-year yields, the durability of earnings as funding costs rise, any inflection in credit spreads from today's tight starting point, and the interaction between a firm dollar, stressed energy supply routes, and volatility pricing across assets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.